that chart there, we can see the credit crisis for the S&L there in the 80s, and the Mexican peso crisis, the dot-com bust, the subprime loan crisis, and now in real time we're heading into the next economic crisis from the tightening of the availability of money in this massive debt bubble that we have.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And lately, the money printing out of the Federal Reserve continues to grow larger, seemingly almost by the day, which certainly those in the Austrian economics and gold and silver community have been forecasting for a while. Seems like a lot of that is finally manifesting as we speak. So it is a pleasure to have my good friend David Jensen, the principal of Jensen Strategic. You can find him at Real David Jensen on Twitter, and really an expert in the metals and the money supply. And David, great to have you on here today to try and make some sense of what is going on. So are you there, and how are you doing, my friend?
I am. Good morning, Chris. Great to be with you again.
Yeah, well, it's a pleasure to catch up again. And hopefully one day we'll have one of these calls talking about how we're rebuilding a sound economy and free market principles are growing and creating prosperity around the globe. Maybe this is the cleansing to get there, but why don't you kick it off and let folks know where it stands?
Sure. I think that everything relates back again to the central planning of the Federal Reserve, and the debt-based money system that they're running, and really the systematic constriction of the money that the Fed has had in place for almost the last 3 years now. Just to give people a sense of the scale of things, the total amount of money that's liquid in deposits and physical cash in the U.S. is about $14 trillion, and that's what's called the true money stock. And the change in that amount that's outstanding every year, the increase historically, is called the money supply. And if we look at a long-term chart of that going back to 1978, we can see that whenever there's been a constriction, originally below zero in terms of the annual rate of increase, so a actual contraction of it. And then in recent years, as the debt has grown to astronomical levels, just bringing the growth of that below 5% has precipitated a crisis. And we can see that in this long-term chart from Mises.org. And we can see that every time they've constricted it, initially below zero and most recently below 5%, that we've had a whole series of economic events, of recessions and of crises. So that chart there, we can see the credit crisis for the S&L there in the 80s, and the Mexican peso crisis, the dot-com bust, the subprime loan crisis, and now it looks like we're heading in right now in real time. We're heading into the next economic crisis from the tightening of the availability of money in this massive debt bubble that we have.
Yeah, and perhaps you could explain for folks why the Fed can't raise rates, why they can't tighten, what is actually happening that makes it really an impossibility for them to do anything like Paul Volcker or raise rates at all.
Yeah, that's a really good point. The total money stock, that's the money out there, as I said, is $14 trillion. Now, if we look at total debt in the US system, it's now $72 trillion. So there's more than 5 times more debt in the system, and that's on all levels: federal, state, municipal, corporate, consumer, etc. It's the whole ball of wax. There's $72 trillion of debt, so more than 5 times more debt than there is money out there. And that equates to about 340% of GDP in round numbers now. Back in the 70s, that was only around a little over 150% of GDP. So Volcker was able to raise rates without bringing down the entire system. Now there is so much debt out there. And just to give you a sense, if you were to go back to the mid 20th century levels of debt versus GDP, there's about $42 trillion of excess debt in the system that needs to be purged to bring the economy back into balance. But I mean, what happened was Volcker was the prime proponent of removing the U.S. dollar from gold backing, and that happened in the early 1970s there. And he was the personal assistant of David Rockefeller, and he was the prime mover in the rush to get America away from gold, away from a balanced and anchored monetary system to one in which you can inflate to infinity, and that is what is happening now.
Yeah, and it's incredible. I'm sitting here and it keeps going through my mind. How do you repay 72 trillion of debt when there's only 14 trillion
Right.
of actual money? Seems like there's a little mismatch there.
There is. It's yeah, my background was I was an aircraft structures design engineer, and we had very clear rules in terms of how we design things. And then you get into this world of economics, and it was just an absolute mind bender for me after my MBA to start looking at Austrian school economics and what's going on in the monetary system, and to say these guys are right off their rockers with what they're doing. It's just the abuse that's going on in the monetary system is astounding, and in no other profession that I know of would it be even remotely acceptable to do what's being done.
Well, let's not shortchange the political trade. So there's one other profession where I think this is at least par for the course. It's funny to hear you also got into Austrian economics after the MBA as well. I had a similar experience there, and maybe that's the antidote to wash out the Keynesian poison. Because yeah, it is amazing how it's just accepted that you just keep printing up a fresh batch of hundreds to solve it, which sure enough, it looks like that's what the Fed is once again attempting to do. And I guess what happens where, we have a lot of money going into the market already. Let's say that, and perhaps you can help break down, we hear these numbers that are growing, some are
Yeah,
rolled over, but let's say the Fed just goes nuts and, you know,
sure.
50 billion a month, 500 billion a month, trillion a month. How does that play out?
Well, can we just jump to the next shorter term graph of the
We
money supply?
sure can.
So there we see, Chris, the constriction of the growth of the outstanding money, and all of this monetary theory that the Fed does, and they talk not a whole lot about it, but what they're doing is modulating the money supply. And that's the flow and the availability of capital. Now, with a debt-based money system, as all the world's economies have right now, an increase in the money supply is an increase in debt. And this is their magic potion for the economy, and it goes back to the quantity theory of money, which you learned and I learned, which basically on one side of the equation is the quantity of money, and on the other side of the equation has the economic output of the economy. And so there is a linkage there between the amount of money and the activity that's going on in the economy.
Mm-hmm.
And so what their prescription is for everything until now is you need more money. And this is Mark Faber so rightly calls them the money printers, because that is what they are. They print, they blow bubbles, they inflate. And then with this chart here, you can see really what I think is malpractice, if not malfeasance, is these precipitous cuts in the money supply, which triggers these crises that we have in our societies. So that's what they've done again now. And so we've got that number 14 trillion of money, $72 trillion of debt, and it doesn't take very much constriction in the availability of money, because that 72 trillion has to be serviced every year, has to be serviced in terms of the interest on it. So if you're not continually increasing the money supply, you are cutting the ability to service the existing debt. And that's what we're seeing here in this chart, is they cut the money supply and they really choke off or constrict the ability of those holding debt out there to service their debt very systematically.
Yeah, and David, I noticed you use the word modulating the money supply. We hear the Fed often talk about how inflation is 1.6%. It's not close enough, so they're going to buy just precise.
Yeah.
They talk about the economy's overheating as if they're going to calibrate it. We're like, we'll do 4.2 contracts to get. Yet again, this is the same institution that even Ben Bernanke a decade ago, as the thing was imploding, couldn't spot it. So am I correct that the idea of just assuming the Fed has this under control, as they're telling people right now, is not necessarily how it's happening.
Yeah, it's never been under control in terms of being able to maintain a stable society. And what's happening now is that it's getting exponentially worse in terms of the instability that they're creating. But throw out the official inflation numbers. You can look at John Williams' numbers, which uses their 1980 Bureau of Labor Statistics model, and shows that today that inflation's running about 8%. But we can just do it with quick checks in terms of, like, in the late 60s, you could support a home with one salary. Now there's no way you can support a home with one typical salary. You need two salaries. And so that's an indication of the death of the buying power of the currency, the debt currency that we use in our society now. And that, that's the real measure. How much does food cost? How much does fuel cost? How much does a new car cost? Look at a new car
Right.
in the 70s. If you look at those numbers, they were, $5,000-6,000. They ain't, $5,000-6,000 anymore. Right. And it goes with almost everything out there.
Yeah, we've been getting a little more than 2%, and it's interesting. Maybe I might possibly be a little focused on it yet. I feel even as if in the last week or two, noticing, I'll go to the supermarket, and there've been a couple of times where I'm like, geez, that seemed like a bit. And,
Yeah.
I think there's a degree to which people expected a lot of inflation, a decade ago, and we've seen a fair amount. I mean, 8%, but we don't have the $11 loaf of bread, or the slice of pizza is not $10 yet, as I think many in the Austrian community, myself included, thought it might be when you print that much. Again, a lot of the money's gone into the financial markets, but do you
Yeah.
think we're
The
now
money's been parked. The
where?
money's been parked in the debt market.
Yeah.
It's been parked in bonds. Right. That's where they hid. Monetary inflation temporarily gets parked in financial instruments. And then when those instruments burn, as they always do, then you have a very near real-time jump in prices. And that's what my former economics prof called the inflation surprise. And there's always whoa, there's a surprise here. We didn't see this coming. And, the 1970s, they blamed it on the failed anchovy harvest off the Argentinian coast, because that drove up fertilizer costs, which then drove up the price of food. I mean, it's insane. It's just so
So
deceptive.
it's always the fault of those anchovies and
Yeah,
speculators, right? It's those
right.
two.
Speculated. Right, right. And what was it called? What were they wore those buttons the back then. They were beat inflation now, or whip inflation now, or something of that order. So, as if it was something that people in society needed to do. No, it's the central banks. They're diluting the currency, and the currency over time buys less and less and less. Done now, though, Chris, is that they haven't just been satisfied with making it buy less, but they've constricted the money supply so that there's now a visible dysfunction in the markets, and they're precipitating a crisis, which we're heading into now. And I think that this is much, much closer than people know, for reasons that we can talk about, going forward here.
Yeah, and to put that into context, perhaps in a way that might really be clear for people to understand, do you think we're on the verge of seeing a Lehman Brothers or a
Yeah.
Bear Stearns, or is one of these banks going down right now?
I think numerous institutions are distressed right now, and we're seeing it in the market. So maybe we can jump to that effective Fed funds rate graph, and we can see, basically on the previous graph, we saw how the Fed had constricted money growth year over year, and put forth that would distress the debt markets. And here, this is a measure. It's the effective Fed funds rate, which is what the banks charge each other, versus the interest on excess reserves, which is what the Fed pays to people that save money with them or hold money with them. And so the difference between those two rates, normally the effective funds rate has been less than the interest that the Fed offers. And all of a sudden, we see that what banks are charging each other has started to move very systematically since the beginning of 2018. Remember, the Fed chopped the money supply at the beginning of 2017, the first quarter, and has held it there ever since. Now, when you dry out the economy, it takes time to have an impact. It takes years for monetary policy to impact the economy. So about a year after the Fed chopped the money supply, all of a sudden we see, a creeping up of the rates that the banks are charging each other relative to what the Fed offers, indicating stress in the monetary system, and that money is not being lent as freely as it was. And most recently, we've seen that in what's called the repo market, which is the repurchase market, an overnight market where the many financial institutions, not just banks, but hedge funds and mutual funds and other money managers can enter that market and utilize assets that they hold and exchange them for cash on an overnight and a weekly basis, depending on the term of the borrowing. But this tightening, this distress that we're seeing in this graph has spread not just from banks, but spread into the greater financial system now. And maybe we can jump to the next graph there in terms of some context of why this is happening. Yeah, there we go. So, I mean, this graph is one of, I'm an engineer, so I always want to know, first order analysis of what are we dealing with here in terms of scale. And you can see that repo market, these are numbers in trillions. So with a T, those are numbers, as a friend of mine says, that used to be reserved for astronomy, but we now use them every day in the monetary system. But you can see there in the repo market. And so that market is about 80% overnight lending. Right. And so that's a $5 trillion market. That's where right now that there's sand in the gears, and we're starting to see smoke and heat coming out of that market. That's a $5 trillion market, and about $4 trillion of that is overnight lending. And that's where things are distressed. The 14 trillion is the amount of money in deposits and in physical cash in total in the US economy. So $5 trillion short-term lending, $14 trillion of total money in deposits, in bank accounts, and in physical cash. And then the next jump there is the 72 trillion that I mentioned earlier. That's the total amount of debt in the system. So that 14 trillion has to feed that $72 trillion debt colossus there. And the constriction and the growth of that 14 trillion is what has precipitated now the crisis in the repo market, in the short-term lending market.
Right.
And then finally on the right there, you see the 210 trillion. That's interest rate sensitive derivatives. So derivatives you call them really bets, but people use them as insurance. They use them as a betting instrument, but they're, generally they're levered instruments, which are out of the money, but when they're in the money, typically out of the money when you buy them, but when they become into the money, they can yield a tremendous return. And the notional value of those bet instruments are about $210 trillion in the system. And this is why, Chris, I think that, we're facing a situation here which can very rapidly go. Can we skip to the last slide there and then come back to this one again?
We sure can.
So you can see on the next graph here, there's the Fed's balance sheet, and we can see that they've entered the uptick there in the last 5 weeks is, September 16th, we saw the initiation of the crisis in the repo market. And since that point, they've injected, in round numbers, about $200 billion into the market. And so this is the Fed providing, we call it printing, but it's a digital process. They buy assets out of the market and dump cash into the market to try to make up for the fact that there's an increase in the need for borrowing beyond what the market can offer in terms of the willingness to give up cash in terms of a repurchase instrument or in the interbank market. They are unwilling to lend to each other to the extent that is needed to provide the liquidity that's required in the market. So can we bump back one slide now to that prior? So, in round numbers, it's about a $200 billion intervention to date, but I maintain that can grow manifold overnight. And this is what I think is really of concern in the current market due to the leverage that we have in the system. The challenge is that there's not enough cash in the system to service the debt. The economy is being dried out. We're seeing all the economic indicators are turning down now. about 2.5 to 3 years after the Fed started, it's really precipitous tightening there in the early 2017. That's pretty typical. It takes, a year to 2 years, 2+ years for monetary policy to impact the economy, which, parenthetically is, why the Fed is not going to be able to deal with this situation with monetary policy, the situation they've created. So the situation that I see, which is concerning here, is that derivatives market is so large that if you start to not just bump up rates, for instance, which have started to jump in the repurchase market, the repo market, but just the increase in volatility of interest rates, which we're now seeing that are starting to go up systematically, that many of these derivative contracts don't just track rates, but they track rate volatility. And we've seen the volatility returning to the market here as there's a scramble for cash. And so the Fed, is $200 billion into this in terms of printing and liquefying. But you can have a portion of that multi-$100 trillion derivatives market where those who are holding the contracts, who are distressed by the moves in rates, say, I've had a movement in the volatility, and this asset that I'm holding, which was out of the money, basically only of a nominal worth, is now worth quite a material amount of money. It's come into the money because the volatility has jumped to the point now that the asset has jumped in value. So they turn to those who wrote that contract and try to make good on it. It could be a CDO, any kind of instrument like that, where they say, okay, now I would like to see the value of this returned to me, and I would like to be paid for this. And so when you've got hundreds of trillions of dollars of instruments, a very small portion of which come into the money with volatility moves, volatility of rates moving or of rates moving themselves, you can have a very, very large or a quantum leap in the demand for cash in a very, very short period, and it feeds on itself as well. So you could see within a day or two, all of a sudden the Fed is needed to provide $1 trillion or $2 trillion of liquidity in the market. And at that point, I think the markets have to be suspended. And that's why I think the situation now is not one in which you're trying to bet in the market as to what to do.
And it seems also like there's not an X event that can happen that solves it. It's not like, maybe the other team fumbles at the last play and you return it. There's not something the Fed can do. It seems like it is past the point of no return at this point, and now we're just waiting to see how it unfolds. Is that an accurate way of phrasing it?
I think it is. I think that from the best of what I can see here is that the Powell and the people in the Fed embarked on a policy direction here, which was there's things that you shouldn't touch, right? We need to reform the monetary system. We need to issue a new currency. But what they've done, it was apparent that we needed to do it before now. But what they've done now over the last few years here is that they've entered into touching devices which shouldn't be touched because they're so volatile. And what they did was constricted the money supply. Now that they've precipitated crisis in the monetary system and the financial system, and most importantly in the economy. And so they've tripped it now, and they've dried out the economy for several years of the availability of the cash needed to continue the debt cycle. And that's now imbued or embedded in the system, in the monetary system, and in the economy. And now by tripping that, there's no quick solution to it. And I think we're going to see a compounding of the situation. The shortage of money in the repo market is really, it's an indicator of a problem. It's not the root cause. The root cause is the shortage of capital throughout the economy, where assets are not rising at the rate that they used to, where there's a shortage of capital to pay debt. The economic cycle is slowing. This is all embedded in the economy, and it's lashing through into the repo market, but it's going to trip into the banking system as a whole and into the economy as a whole here, I think, in short order, Chris.
That was part one of my interview with David Jensen. Check back tomorrow when I'll be posting part two, where he talks about what's going on in palladium, which is perhaps a reflection of everything he discussed here, and also if that might happen in the silver and gold markets as well. So you'll definitely want to catch that. Hit the subscribe button so you'll be notified as soon as it's posted. And as always, do appreciate you watching.